I sold a put option in a stock that just dropped 6% over the past few days. What made it even more interesting is that the option trade I did, it only pays a 14% annualized return over the next 28 days. My personal goal is at least a 15 to 20+% annualized return on all my option trades. But what I did next with this option trade changed it from being a so-so option trade into one that paid an over 23% annualized return on one account, and in another account, an over 100% annualized return. Let me show you exactly what I did with these two Verizon option trades that boosted my return 7 times what I was going to receive originally. I do this in 2 ways. I'm going to show you using 2 separate trades. First, let me show you why I did this trade. We're looking at the hourly chart of Verizon up until the hour that I sold these cash secure put options against it. Notice over the past several days, Verizon had been in a pretty strong decline. It had recently declined right around 6%. Notice it found support in this general area around the 25th of April. Then going back a couple of days to the 21st, it found support again around that $41 area. Going back to the early April, notice it found support multiple times in the same general area. So I believe that even though Verizon had recently experienced an over 6% decline, it was most likely at an area that it was going to find support. But that wasn't my trigger. My trigger was this line here. Notice when it broke through and closed above this trend line, this downward sloping trend line, this diagonal trend line, that was my trigger to sell some cash secure put options against Verizon. And if I switch over to this daily time frame, you can see that support a little bit better. Here you see the support from back in early April. If I go all the way back here, notice that even in March, it found support in this area. Then back here in early 2025, it found resistance, which remember, resistance once broken through, it tends to turn to support. So let's look at one more time frame to help you see why I did this trade. Now I've switched over to the weekly chart of Verizon. And notice in the general area around $40 to as low as $38.85, Verizon showed some really nice support. So I felt good that if Verizon did come down, it finds support somewhere in the $38 to $40 area. But my trigger was when it broke this downward sloping diagonal resistance line on this hourly chart. So here's the trade I did. Notice that on June 20th, I sold the July 18th $40 cash secure put options. And that paid me about 43 cents per share. If I do the math for you, notice this return was expected to pay us around a 14% annualized return. And for those that want to see the calculation of the math, we simply take the 43 cents that we received, divided by the 28 days that we'd most likely be in this trade if we did nothing about it, multiply it times 365 days to annualize that return, then divide it by the strike price of the put. That gives us a 14% annualized return just as this sits if we're in this trade the whole 28 days. The reason why I'm sharing this trade with you is because I get asked a lot when I do trades, Randy, I thought you target a 15 to 20+% annualized return. Why are you entering a trade that only has an 8% annualized return or a 14% annualized return? Let me show you why. Now, one additional point I want to mention to you, this is something I personally like to do. I prefer to sell put options in companies that I believe are undervalued. So besides the technical reasons I showed you on Verizon's chart why I entered this trade, I also believe the company was fundamentally undervalued. They'd be even more undervalued at this $40 cash secured strike price. So that's the why. Let's see what happened with Verizon over the next several days. So this yellow arrow is the hour that we entered this trade. So each one of these bars is 1 hour. So as time passed, notice what Verizon did. It went up, then it came back down to retest that same area for support. And indeed, it did find support. And then it began to take off just like we expected it would. So we're going to fast forward all the way to July 9th. And now as you see the yellow arrow on this hourly chart, this is when I adjusted this trade. This is when I turned a so-so trade into an absolute winner. Now the first way I did that, bumped my return up from a 14% return to an over 23% annualized return. Remember, the expiration date I originally picked was July 18th, and that was 28 days into the future from when I did this trade. Well, fast forward to July 9th, and you see I bought to close this put option out early. I bought to close the July 18th $40 cash secure put option. It only cost me 4 cents per share. So right about 10% of what I originally received for selling this put option. But in so doing, I closed this trade out 9 days early. That immediately bumped my return up. It only cost me about 10% of what I originally received for selling this put option. I exited this trade over 32% early. So that was one factor that dramatically increased my return on this trade. But this was the other thing I did to dramatically improve my return. If we do some quick math here, notice that my broker was only requiring that I had $794 set aside for this trade. And that's compared to if I did this trade in a cash account, I would have had to have $11,520 set aside. So the amount of capital I was required to have sitting there doing nothing to secure this trade was a lot lower because I was doing it in a margin account. As a result, I was able to collect interest on the excess money, which was over $10,500 extra that is sitting in this account for this trade. So I improved my return by closing the trade out about 30% early, and I also improved my return because I did this trade in a margin account. Therefore, the cash my broker required I have set aside for this trade while it sat there idle waiting for something to happen was a whole lot less than it would have been if I did this in a cash account. And just so you know, right now in this account, I'm receiving about 4.5% annualized interest for my excess cash. As a result of these two factors, my return on this trade was over 23% annualized. But it gets even better than that, because in my small account, I did something that bumped my return up to over 100% annualized. And here's what I did. All right, here you see the trade I did in my small account. Very similar trade, but it has one little tweak here. I'm going to show you how to dramatically increase my returns on this account. So you see, we sold the exact same put option, the July 18th $40 put option. But then we capped our downside. We capped how much I'd be required to have set aside for this trade. See, this is my retirement account, so it acts like a cash account. But that's only the case if I don't do something about it. So here's what I did. I bought the same expiration day, July 18th, $33 put option. Let's do some quick math here. Instead of being required to have $4,000 set aside for this trade, by turning it into a spread, I not only bought myself some cheap insurance in case Verizon just dropped out from under me, but I also limited how much capital I had to have set aside for this trade. So let's recap what I've done here. I bought myself some insurance by buying that same July 18th $33 put option. That meant at most I could lose $700. As a result, my broker only required me to have $700 set aside in cash for this trade. Compare that to the $4,000 I would have had set aside if I kept it as a $40 cash or put option. We end up saving $3,300 worth of cash. So what did I do with that cash? Well, I put it somewhere that'll pay me some interest. See, unfortunately, my broker here, E-Trade, they don't pay interest on cash, but I found a way around that. You see, I do these bullish put credit spreads to limit how much cash I have to have in this account. I then take all that excess cash and put it into SGOV. As you see here, that's a 0 to 3 month Treasury ETF. Now that pays a nice dividend. In fact, as you see here, as of the date I'm filming this, it's paying about a 4.53% annualized return when it comes to its dividend. It's a nice place to park your cash. And one more thing, if you want to park your cash somewhere, you want it to be very stable. Notice how stable this thing is. Now it doesn't look very stable here. Let me blow this chart up for you. Now we're looking at the 5-year chart. We've been through some pretty wild things over the past 5 years. But notice what's happened to the stock price during that time. Going back in here in 2021, 2020, 2022, notice at the far right, it's trading for around $100.03. Well, now this chart looks like it's gone all over the place, but notice at the peak up here, it was trading for $100.71. So a very stable ETF driven by the US government, and it pays a nice dividend of 4.53% as of today. So that's where I park my excess cash that I have setting aside, waiting on positions to be assigned to me, because I do have the cash set aside in case this put option was assigned to me. But instead of just selling a cash care put option, which in this case we require me to have $4,000 set aside, I turn it into a bullish put credit spread. That means I can take that other $3,300 and buy some SGOV. And although this is a small account, it really does add up. Notice just last month I received over $98 for just the extra cash I have sitting in SGOV while it waits to be deployed into cash care put options if they're assigned to me. And I have 2 more things I want to share with you that sweeten the pot on this trade. The first one was closing out early, as you see here. I had to wait one more day to achieve my 90% of potential profit, but notice on July 10th, I bought to close that July 18th $40 put option for 4 cents per share. So I was able to pocket over 90% of the potential cash for this trade, and I closed it out about 8 days early. So what did that mean? Well, the final bonus I want to share with you is what I did next the day after I closed this trade out. The day after I closed this Verizon trade out in my larger account, I was able to take that capital and put it right back to work. I sold to open the NVO October 17th 55 puts and got 92 cents per share. Now this trade is still in progress, so we'll see how it turns out. But by closing it out early, I not only improved my return, took away that risk in case Verizon were to come way down in price, but I put it right back to work the next day in another position I liked just as much, or really, I liked it even better because the return was a lot better. This trade teaches an important lesson. It's not just about making money. It's about how you make that money. Is it done strategically, in an intelligent way, or is it done carelessly? Annualized returns, they matter, especially over the long term. If you can do things to tweak and adjust and improve that annualized return, even by small amounts, well, something you should probably consider. Consistent wins, even if it costs you a little bit of money to close these out early, consider closing them out, especially if you're able to receive 90% of the profit in 70% of the time. And that's exactly what happened here with Verizon. If you'd like to get an alert whenever I buy stock or sell options, check out the benefits of becoming a patron down at the link in the description below. I won't even try and say this YouTube viewer's name here, but I know they're from South Africa, so that's awesome. It's a long way from where I'm at, so thank you for watching. They said, please help how can I hedge my leaps option trades to protect during a downside move? If you'd like to see how I like to hedge my positions, check out the video at the link above and the description below entitled Hedge Your Portfolio Like a Pro. Until next time, happy investing, and we'll see you again soon.